Real Estate Investing 101. When you buy a home, people often remind you it could be the biggest investment you'll ever make. But should you use that investment to help fund your retirement? What about rental properties? How can you maximize their potential for your retirement? If you're wondering how to integrate your real estate investments into your retirement, or are interested in real estate investing, these tips are for you. First, the finances of real estate, cash on cash. Make sure that you understand the finances of real estate, because ultimately, you're here to make money. The first thing you should calculate is the cash on cash percentage. Cash on cash is your net profits divided by your equity. For example, assume that you have $100,000 of equity in your property. Your profits, after all expenses, are $3,000. Take $3,000 divided by $100,000 and that equals a 3% cash on cash percentage. Realize different areas of the country have different ratios. Texas might be around 10%, and in California, you'd be lucky to break even out of the gate. Second, buy rental properties for the cash flow, not the flair. The most conservative way to invest in real estate is to buy something for cash and to collect cash flow. If you introduce leverage by acquiring a mortgage, or if you're counting on appreciation and speculation to be your return, you're taking on more risk. In a booming market, you can make more money that way, but in a down market, you can also lose a lot of money. It really comes down to this. For every dollar invested in that property, how many dollars are going to come out after all of the expenses have been taken care of? As you go up the ladder in terms of price point, you don't necessarily see a commensurate increase in the rental rate. Now, there can be certain nuances to that depending on which market you're in and where there's demand. If you live in a place where there's an obvious tourist attraction, or if it's right on the water, where you always have a high demand for short-term, high-dollar vacation rentals, that can be a bit of an exception. But if you're just looking for a tenant who will be there for a few years and be a steady source of cash flow, you typically do better with a more modestly priced home. Keep in mind that the $1 million home isn't necessarily going to have 10 times the rent of the $100,000 home. Third, minimize taxes through real estate investing. Real estate can be a great investment and a great write-off, but only if your income is below $100,000 or you qualify as a real estate professional. If your income is $100,000 or less, you can deduct up to $25,000 in excess rental losses. If you make between $100,000 and $150,000, then you can only use part of your losses to offset your other income. There are no real estate losses allowed when your income is above $150,000. These losses are referred to as passive losses, and any unused losses will be suspended or carried forward until either you have the income on your property or you sell your property. Being a real estate professional means you have to work at least 750 hours per year on your real estate investments, managing, buying properties, etc. You also need to have spent more than half of your total professional time in that year in real property trades or businesses, and you need to materially participate in the management of the property. If all these requirements are met, then you will be able to write off your passive income losses against other income. Finally, leverage. Plan strategically. If you want to get started in real estate, you can use other people's money to increase your returns. Consider this. If you use all cash, then the property goes up 5% in value. You made 5%. However, if you put 10% down and it goes up for 5%, now it's as if you made 50% because you have less invested and are now the equity owner. The problem is if the property goes down 10%, now you've lost 100% of your investment, and that's where you have to be careful with leverage. For example, when you buy properties with high leverage, that means a high loan. With a $100,000 property, you put 10% down, $10,000, and borrow $90,000. If the property goes down 10% and is now worth $90,000, you've lost 100% of your original investment. Here's another consideration. In markets where real estate prices are falling, rental rates tend to fall too. High leverage can be risky because reduced values and rental rates could mean that you can't sell because there's no equity, and you can't cover your rental expenses because your rental income is lower. Moral of the story, leverage can definitely work for you, but it can work against you in poor markets. When it comes to investing, whether in real estate or the stock market, there's always risk and hopefully reward. If you need help in determining what investments are right for you, contact Pure today for a free financial assessment.